It's Thursday, 20th of November, and the number of the day is 25 basis points. An early Christmas present from SARB Governor Lesetja Kganyago. Now, with me to discuss the latest interest rate announcement, we've got Koketso Mano, senior economist from FNB. Koketso, thank you so much for joining us here in our studio. Was this announcement expected?
Not expected on our end. I think as a lot of analysts may also be in the same camp, we were sort of thinking maybe after the July MPC especially, maybe you don't see cuts coming through for the remainder of this year. As I mentioned a lot of times, Melissa, it takes some time to manage inflation expectations. I don't think you and I are necessarily already thinking with 3% in mind when we go, negotiate with our employers or when you think about your own budget. But I think that is the process that we thought might take a bit of time and may delay interest rate cuts coming through. So yeah, but we were positively surprised. I think this is a good thing.
I also think it's a good thing, not just for my own pocket. But let's talk about the upside risks to inflation. Now, Governor Kganyago did say the inflation expectations are balanced. Now, this after we got that 3.6% shocker yesterday. What do you think?
I think the uplift in inflation was expected. So how we always explained it, especially coming into 2025, was that 2024, you were going into the latter part of 2024 with positive base effects. Now, I'll explain that, right? Because inflation, how we tend to look at it is that it's year on year. So you look at the price level in 2024 versus the price level in 2023, and then you see that the change between the two can drive your rate of inflation lower. And that's what we saw going into the latter part of 2024 and coming into 2025. And so we knew that now in the latter part of 2025, though that goodness in the statistical way of looking at inflation would be out of the system. So we knew that the uplift was coming. I think what the MPC is focusing on is the uplift shifting us well away from 3%, which we don't think will be the case. And I think that really provides them that comfort that they will be able to achieve the 3% within the medium term, which is to 2028.
Before we get to that inflation target, because Governor had quite a bit to say about that, let's get to the fact that the decision was unanimous today. It's not usually unanimous when it comes to a cut.
Yes, and everybody gets so excited around talking about who's a hawk and who's a dove, right?
Exactly.
We all love doing that. But it seems as though everybody was on board today with regards to, monetary policy is still restrictive. We like to say interest rates are coming down, and yes, we got a 25 basis points. But when we as economists think about how monetary policy is feeding into economic activity, we still consider it to be restraining economic activity. So I think what the MPC really decided to do today is to reduce that restrictiveness. And it feeds into the positivity, right? We got a ratings upgrade. The MTBPS look good. We hope that demand will start to pick up and hopefully we get that 2% growth over time.
Well, we can only hope for that as well. But let's quickly go back to that inflation target because that is something that could potentially boost our economy. Now, SARB Governor specifically said, he talked about the 1% tolerance band to both ends, but they're targeting 3%.
Yes.
So if we look to 2026, do you think the SARB will have a wait-and-see approach about any further cuts? I know that they said specifically with the inflation, they've modeled and according to the 3%, and like I said, it's 3.6%. It's no cause for concern yet. But if we look to next year, could we then suddenly see a turn and make it even more restrictive policy in 2026?
Let's hope not. I think, there are a few things that could unfortunately shift us in that direction, right? Which is maybe if administered prices are not behaving, which we can expect. I mean, there's already a scenario that they ran where, we may have to absorb higher electricity costs because of accounting issues. But we generally know that, even with the 3%, you couldn't really expect Eskom to come next year to NERSA and say, we will allow 3% increase on our baseline. But I think there's a lot of price rigidities that could delay the cutting cycle, which can be expected, right? Even price rigidities at our level, as I've already mentioned, when we go to our employers, are we ready to internalize that 3%? The other thing that we like to speak to is when you look at the multi-year wage agreements, those are not at 3%.
No, not at all.
And those are multi-year, right? So they're still baked into the system. So it's going to take a bit of time. And unfortunately, monetary policy may need to remain restrictive, but it does not mean it has to be as restrictive. Now, this is the part that I think is interesting. What is the level of restrictiveness that is required to drive our expectations lower. It may not need to be at the level that it is now. And so that's why I'm saying the MPC probably has leeway to lean more into, not having such restrictive monetary policy. So if they are forward-looking and they believe that this process will work, they believe that they're credible, they believe that their communication will be really good, they believe that with reforms, the cost of doing business in South Africa will be lower, so price pressures will be lower, then yes, you don't have to wait for 3% to be the norm before you start cutting interest rates.
Interestingly, trade tariffs weren't mentioned.
Yeah.
So in previous meetings, there was a lot made about the trade tariffs and the potential impact it could have on inflation back home. But it wasn't cited today as a concern. And I know a few other economists have also said it was more a bluff than a bite, more a, what do you call it? More bark than a bite.
Yes.
So, what do you think if we look forward to 2026, if we look at local factors, like we said, we've got that sticky food inflation, but then we also still have that global market uncertainty. What do you think will tip the scales here?
You say bluff because in Afrikaans is what?
Yeah.
I get you. I got you.
Thanks.
I think the global dynamics have, were threatening at the start of the year because we didn't know exactly how they will materialize in the numbers. What South Africa has benefited from here alongside other emerging markets is we've started to import the disinflation from China, right? And that has really played into the inflation numbers that we're seeing now. Think about the cars that you're seeing on the road, right? All those weird names that you're not really accustomed to. Those are all the cheaper imports that have, mitigated the price pressures that we thought we might get from this trade regime from the United States. So I think that has been positive. I think also when you look at it from a risk perspective, South Africa's reform agenda really plays well with how, international investors are looking at this market. From a banking perspective, we're hearing about foreign people being interested in our property market, being interested in local, even unlisted companies, right? So there's a lot of interest here if you look at the bonds as well. I don't think the international dynamics are going to be as strong as the local dynamics, the structural reform, the price rigidities, all of these issues that we need to grapple with that make us uncompetitive when you think about the cost of doing business in South Africa. Those need to be resolved. Let's
end on a positive note, growth outlook. Do you think we will achieve that growth that all of us need, be it for lower interest rates, lower inflation, more jobs?
We will. I think 2% growth is a weak target, right? It's not anything for us to get so excited about. But unfortunately, we become so accustomed to low growth over the past 10 years that I think 2% becomes this great target. But what we need for unemployment to actually come down with the population growth that we've seen is something around 3.5% and above, right? So we should be thinking alongside that. How do we reindustrialize this economy so that more people start getting jobs? But what I like about what macroeconomic policy has done, we've seen Treasury having a very reform-driven MTBPS. We've seen the Reserve Bank saying, this is how we grow sustainably with low inflation. So what you hope for over the longer term is that you start getting that real GDP growth, not nominal GDP growth, but real GDP growth that really creates jobs for you and I and everyone else.
Thank you so much for joining me today, Koketso. Well, that's the number of the day, 25 basis points, just right in time for the festive season.